Welcome to Business Redefined. We are discussing money market funds. Is your risk appetite quite subdued? Are you very conservative in terms of how much you want to take up risk in the investment landscape? Today we are focusing on the discussion on money market funds. What are they and what should you be looking out for when you're tapping into this asset class? And we are privileged to have Eric Karimi, who is a portfolio manager at UAP. Welcome on set.
Thank you.
Let's just begin with a very brief intro for those who might not be aware of what money market funds are. Just give us a breakdown of what they are.
Money market fund is essentially supposed to be your most liquid asset, comparable to cash. The definition of a money market fund is one that is invested for less than 364 days. The average maturity being about 1 year. So in the money market industry, you look at anything with the maturity lower than 12 months and is essentially supposed to be there for you as your savings and your most accessible liquidity. And that is what the fund is meant to be invested in, because you're looking at a fund that is going to be able to give you access to your money anytime you want it, anytime you need it.
Great. And looking at the various avenues through which you then invest this capital, it would be, we're looking at T-bills, we're looking at some commercial paper in that scenario. When you look at that horizon, do you feel there's, should I say, enough diversification in terms of where you can put in this capital?
Yes, there is enough diversification, because the thing about maturities of different tenors is you can diversify through tenor, 3 months, 6 months, 9 months, 12, 2, 3, whichever, different banks, different securities. You have T-bills, and you also have bonds now, and which is only a matter of diversification of risk. So we all know all the number of banks that we have, which offer enough of diversification for any investor to be comfortable. I think the main thing is to know where the diversification is, yeah, and the kind of risk you're taking.
And looking at the return, when you invest in T-bills, you and I know that if you look at the sovereign yield curve over time, it has been coming down. Yeah. So that's that right now, if you look at the 91-day T-bill, for instance, it's giving you about 6 point something%. Yeah. A few years ago, we'd be talking about higher digits than that. What's your outlook on the income profile that money market funds will be able to give going forward?
It definitely has to be pegged on the government's 91-day T-bill. So you expect it to go lower the safer. The more you expect there to be a positive outlook on the government's ability to be able to contain its sovereign debt. But the issue around money market funds is you expect them to be the lowest yielding funds, because it's money it's like a savings account, it's closest to you. Where we're probably headed is we'll have an array of money market funds that have different risk profiles. And I think that's what the regulator is trying to do. You have to say what it is that is inside your money market fund, so that when people come and say, just as with any other instrument, I'm investing in this, I know what's inside, and I get a higher return because I'm investing in more risk. So you have all sorts of funds like this in the West, where the safest fund, maybe a sovereign fund, will be close to zero, and you have different risk profiles and offered by the same fund manager.
How does someone get started as far as investing in a money market fund is? Granted, this could vary from player to player, but in terms of minimum requirements, how does this look like?
We've actually made it quite easy to invest in a money market fund. We have digital capability to be able to invest. The minimum investments amounts, as we've been talking about, have actually been quite low. So you can sign up for a money market fund on Facebook. We have USSD registration, so all you need is your ID and your phone number, and you're good to go, especially now with the new phase of mobile phone registration. So that's pretty much all you need to buy into a money market fund. Once you're in, you're in. will definitely, for any subsequent investment that you make, you should be fine.
Do we have deposit guarantee or insurance when you talk about putting our capital in money market funds? Because many would-be investors out here will tell you, we would like to consider it, but do I have deposit protection when I invest in this?
Not really. You don't have direct deposit protection. What you have is protection of the deposit in your fund. So if your fund has deposits with banks, you're protected as much as each deposit that you have with each bank. But if your fund doesn't have deposits with a bank, then the protection is just based on diversification of the fund or whatever contract is in that. So not directly through the fund, because the fund is supposed to be a collection of investments, of risk. But with each deposit, as long as it's considered by KDIC or central bank as a deposit to be insured, then it qualifies by more or less a small portion. Okay. So the risk profile really matters a lot.
Are there any tax benefits associated to investing with the money market funds?
There is some tax benefit in the sense of compounding, because the collective nature of the scheme allows it to get interest free of tax within the period in which you invested in the fund. And for that sense, then at least you get the benefit of your interest, accruing interest, which is a big thing, because for most investments that most people do, they don't get plowed back. If you earn 5% this month, or 7 or 10, the next month that 10% will earn another 10%. If you have a 6-month deposit at 10%, that 10% is going to accrue on the principal. So that compounding effect is not felt as strongly.
And then the question becomes, if money market funds offer such a strong proposition for the market as far as aggregating capital is concerned and growing your wealth, why is the penetration so low?
I think it's just gaining investor trust, information, the kind of work you're doing, which should be, we need to demystify what a money market fund can do, or what a fund manager does, to be able to segregate the kind of service that we give, so that we do not have a misconception of what it is that you're investing in, and having the proper say comparisons. Yeah, I think investor education is the key gap between money market fund and its own take-up in the market.
And how liquid is a money market fund investment? Because I'll tell you, majority of us out here, when you're investing, you want to be sure that if I want to liquidate it, I can get my money at the soonest time possible.
Yes, which is a promise we're making.
How liquid is it? Yeah.
It's very liquid. It should be liquid. No one should tell you to take out your money out of your money market fund and wait. You should be able to get your money within a week or so, because the nature of these investments is they're either there or they're not. So it's short term. The regulator alludes to having 13 months of awaited maturity in your fund, which means even if you have longer than that, you should have things in your fund that should be able to give you liquidity very soon. And that should be the nature of your fund, in the sense that it accrues the interest of a short-term deposit, such that anyone who wants their money now can get it, and that's the promise we're giving, which is the liquidity. It's an open-ended fund.
And what do the withdrawal terms look like? And why I ask this question is, we mentioned this before. What do I expect you to demand as by way of fees? What percentage are you looking at here, so that when I'm coming for my capital, then I know what to expect? The
fees, you see, for a money market fund, the return that you have is net of fees. So you should expect to see the return that you've accrued during that period as is. Yeah, net of tax, once depending on your tax liabilities.
There is a perception out here that money market funds are a very elitist product. They target a particular cadre in the economic pyramid.
Is this the case? And if that's not the case, why is this perception still among Kenyans? It used to be the case. It's what we're trying to defeat, which is trying to show people that the money market fund or fund manager can be available to any individual. Anyone who has any interest, we're now accessible to them. And also to build a different perception of what is being on offer, because most people want certainty. They want familiarity. So they will prefer to go with a very defined offering or a product other than coming for something that sort of seems a bit vague to them. And the regulator is trying to do the best to keep the public's interest at heart, so that anything, all their money that they invest in public funds is protected. And this is going to have a bit of an impact in demystifying some of the things that we have, some of the barriers that we're experiencing with money market fund investments. But the idea is to give them that certainty that their money is safe and that we're on this journey with them. A lot of people you speak to out here who play within the money market fund space will tell you that they are in because they have short-term objectives. And there is the view that perhaps it doesn't accommodate those with a long-term horizon for their investment. Is that the case? Yes, for money market fund, depending on your risk profile and obviously your investment horizon, most people will tend to want to invest money that they'll need within a year, and they don't want to lose capital on. But if you're willing to invest your money for longer and you're willing to take that risk, you'll definitely, we have products that have an investment horizon of 5 years in the equity fund where you can be able to put in capital that you're going to forget for quite some time. In September 2020, we saw the market regulator, the CMA, come and issue guidelines on the valuation and reporting by collective investment schemes like yourselves. And the reason behind this was that to give a sense of normalization around the indicators being tabled out there, such that if a fund tells me they're guaranteeing me, 13% per annum, then clearly we are comparing apples for apples with other funds across the industry. Let's just start with this. How do you think this is impacting the market? It will be good investor education, because first, I think the idea is to give people a better view over the viewing glass on what they're comparing within funds. There's been a lot of hearsay. When you look at the paper, you see a different rate and this, you don't know what this means. So there's a push to have all this information out there so that you can be able to compare fund managers and also be able to see the risk that you're taking for yourself. And if, for most people, either we're calculating some of these interest rates and whether or not you're actually getting the same return you think you do is quite difficult. And they need the regulator to be able to step in and say, if you say you're giving someone 10%, you're giving them 10. And what are they getting for that 10? And what is the risk that they're taking for that 10? So let me get this clear. When a fund manager tells me that in their money market fund I'm getting 10% per annum, that I presume is net of management fees, or how does it work? It's supposed to be the rate accrued to you on a daily basis. So depending on whatever form of reporting you're doing, you can average it out over a week, and those are the things that they're trying to standardize. So that you say, obviously you can't give a daily rate, but if you say this, then there's a very standard way of looking at that rate and comparing it with another one. We've seen this with other regulators such as banks, saying this is a cost that you give, what does it mean? What are you telling investors? What are you telling your clients? Can they be able to actually compare? Is there a market for them to walk around for loan rates and find out? It's the same thing for this one. Yeah. So it will be net of fees, but there's a bid to close that gap so that we can have the same thing, because we can say net of fees, tax, because it's different for different people. One of the value propositions that money market funds boast of themselves out here is the fact that every fund, ideally, has a fund manager, has a trustee, and has an external auditor.
Could you just walk us through why that is significant and what role each of them plays?
For a money market fund, I think one of the misconceptions about investing in a fund manager is you do not buy a product. You're getting a service and someone who's doing that for you. And if they invest in this money for you, then they are taking what you would buy from someone else, and they're trying to generate a return for you with the overview of the regulator and a trustee who is, say, the person acting on your behalf, because all of us cannot be sitting across the room from a fund manager. We have a custodian who is there to make sure that the money is safe, and the fund manager is actually, it's not our money, it's your money, and it needs to be in custody with a bank so that they make sure that we don't do anything with it. The same thing with a trustee, they're there to be there on your behalf. So for the fund manager, that's what we do. We do offer with the front facing of the product because the main service is ours, but the idea is to be able to give you that kind of service and not really a product directly.
One thing you've recurrently mentioned is risk appetite. I'm sure there's a viewer who wants to know, how do I determine my risk appetite? Because it is not obvious to everyone that I am high risk, I am low risk, I'm just moderate.
Yeah, for most people actually they have a very bad view of their own risk appetite, because investments is actually a very foreign thing to a lot of us. Not necessarily in the context that we look at it now, but usually. So you need a professional to be able to talk to you and tell you, this is what you need to be doing. Some of these things actually you know by yourself. So you know you should be doing X, Y, Z. You know you need a safety fund. You know you should be trying to invest in the long term. And you can ask yourself, if this money, can you have it, do you need it for more than a year? Can you have it in 2 years, 3 years? If you can't, then your answer is straight away. If you need this money now, you need this money now. You can't start trying to get something out of it. It's just like a savings account. So some of them, by rule of thumb, you know them. Some of them, you need a professional guide. We're working on a number of things to be able to digitize risk profiling for clients, where you can go onto a site or an app and just give your own goals and income and investment profile, and it spits out something for you that tells you you can be able to put this much in this fund and this much in this fund.
What happens in the event that I'm in a money market fund and I go for a long time without making any remittance? Are there penalties that are imposed on someone?
Your fund remains as is, continues to accrue. So we'll call you once in a while to find out if you're still looking at your investment, because we're required to by the regulator also to find out if you would want to achieve your goal and what has happened to it. But there are no, it's your money, it's in the bank. We won't make your account dormant. We won't freeze your account and charge you money to take it out. You should be able to see your balances anytime you want, as long as you have your statement. And this is actually just what we're trying to do for them, is just make it available.
If I have a money market fund account, I've invested, and God forbid I pass on, what happens? Because, and why I'm asking this is because of the aspect of unclaimed financial assets, and I'd imagine this also affects MMFs.
Yeah, it does.
Yeah.
So this is one of the reasons why we want to keep contact with clients, so that at least we make sure that the next of kin is available. If anything happens to you, we want to maintain contact to see who we need to update your details and find out who's your, where the money has been coming from, what we need to do. We do have a window of about 3 years or so, but regularly we feel that it's important to keep contact with clients so that we don't have to have that conversation at that time, that we know everyone that you know. You're just a phone call away. If I call, I can call someone else and we'll find out what has happened.
A lot of the more sophisticated investors will tell you that, okay, fine, we have the money market funds here, but why should I go there when now I have a derivatives option in the capital markets, yeah? Such that I could be in equities trading, but then also I have a cushioning effect already. So if my risk profile is such that I want that sort of level of assurance, I can get it within the equity space. Yeah. Do you think now the derivatives are stealing the thunder from money market funds?
It's a complex place. What we talk about investment knowledge is, even for some of the most well-trained people, they get lost in derivatives trading. I've seen it. It's all uncertainty. You can try to hedge and cushion, but these arbitrages, they don't stay on for very long, because who is going to take advantage of it? There has to be someone who comes in. And that's why there are those market makers and all these people. So if you're not aware of your risk, you're better off investing your basket somewhere where you feel safe, and leave that to someone else who will be able to do it for you. If you're a sophisticated investor, you can do it, but it needs a lot of time and effort and attention, so that you don't lose all your money. It's still a bet you're taking.
And that point by Eric Karimi takes us to the close of our conversation on Business Redefined, where we have been looking at money market funds. Remember, if you have a low risk appetite, this is one of the vehicles you should be considering to plow in your capital. Up next is the Markets Report.